Hi, my name's Boehlje, and today I will be your accountant for Beaches LLC. Today we will discuss your recent purchases of your new equipment as well as your new laptops. First, I will start with what categories these are in, followed by the depreciation and how that will work, and ending with how this will affect your financial statements. To start off, your equipment costed $5,000 to purchase. Now, with depreciation, your salvage cost by the end of 6 years will be $1,000. This means that during the course of those 6 years, you will lose $4,000, equating to roughly about $666 a year. Now, this means that you also have the purchase of $6,000 in laptops. These laptops will also depreciate at the same time that your equipment does. Even though they're estimated to have a life of about 3 years, our costs cannot be found. However, we will still continue to add depreciation onto our balance sheet each year. We must make sure that we will not skip this step. Both of these items will go under your balance sheet in your assets section, and to be more specific, they will go into a category called your property, plant, and equipment section. Now, we will start off with talking about your equipment section, of course, because this is where your equipment will go. So this is where all your assets that involve your depreciation on your balance sheet will be seen. This is also where you find assets involving property as well as land. So your equipment and your laptops are classified as tangible assets. You can physically touch these assets. They can be held in your hands. They can be transported between employee to employee, as well as they make your day-to-day job much easier. You can physically use these items. They are items that you will use in your program and whenever you need. Now, these are different than intangible assets, which are your trademarks or your copyrights. Now, these assets cannot be touched. So these just kind of help your business to have so if someone decides they want to steal your ideas, will these help your business to make that not happen? These protect your business from things such as rebranding or things such as people stealing your ideas and they're not supposed to. So your natural resources will be those such as your oil or your timber products. Basically self-explanatory, they will be your resources that are naturally given by the earth. So this section appears on your balance sheet underneath underneath your current assets. So it will go underneath your assets, but it will still be in the assets section. So it will go and it will all equal out to your total assets because while your equipment is depreciating, your equipment and your laptops are still an asset. You are just subtracting the depreciation at this time, but they still need to be above your liabilities and your stockholders' equity. So this will continue for the next few years. Now, once your items are bought, they will start depreciating immediately. I like to use the analogy of once you start driving a car, the miles that you put on the car can never be taken off. So the same goes for your equipment and your laptops. Once you start using them, they will never go back to being brand new. This means sometimes your laptops may have glitches, sometimes your equipment may have trouble functioning, stuff like that. It doesn't mean that it's not useful, it just means that over time they do become less valuable. Because they have these problems, eventually you're going to need to buy new ones to replace them, but those are much farther down the road. So this depreciation is noted under your balance sheet under your equipment. So to give you a visual, it will go your current assets and then it will go your total current assets. And that number is kind of in bold, as it makes it easier to see. Then you would have your property, plant, and equipment. This is where underneath that you would have an equipment line, and then underneath that you would have a less equals depreciation. And this means that you are subtracting your depreciation from your initial equipment asset number. So initially it would be $5,000, but you would subtract your depreciation, and whatever your depreciation is for each year, that would be your new equipment number. So, once you have completely used up your equipment, it will remain at a salvage cost until you completely dispose of it. You must completely dispose of it to make sure that it is off of your balance sheet. If you don't do this, then it's still going to be a salvage cost and it's still going to be a number on your balance sheet, and eventually it will become a liability. All in all, your balance sheet in the end should have your assets and liabilities plus stockholders' equity be equal. So on every balance sheet, your assets must equal your stockholders' liability plus your stockholders' equity plus liabilities. This is why you must be extra careful to include your depreciation costs of your numbers, or they will not even out. So if you make a mistake and one of your depreciation numbers isn't correct, then your stockholders' equity and liability will not equal your assets. This is how you know that some mistake was made, and you can go back and search for it, but make sure that they are equal. Lastly, I will describe how these purchases will affect your financial statements, such as your income statement, your balance statement, and your retained earnings. To start off, whenever you purchase an item, you must record it as an expense. This is not money that you are receiving. It's not a revenue. It's not a service that you provided. It's money that you have taken out of your account and you are purchasing an item, whether that be in cash, accounts payable, or whatever system you would like to use it as. So this is recorded on your income statement, and your income statement has your revenues minus your expenses, which gets you your net income. So this is extremely important to add your expenses because your net income determines your retained earnings. Now, if your expenses does not give you the correct net income, it then doesn't give you the correct retained earnings, and retained earnings is a stockholder's equity, and that then would not balance your balance sheet. Your assets would be a higher number or a lower number than your stockholder's equity plus your liability. So you figure out retained earnings by having your net income or loss subtracting your dividends. Now, this again would falsify your balance sheet if those numbers are wrong, because it would either add more net income, add more retained earnings, or less retained earnings, which would make your numbers false. So retained earnings fall under your stockholders' equity on your balance sheet. And again, it is so important that your assets equal your liabilities plus your stockholders' equity. This is why your balance sheet is called a balance sheet. So, to recap, I want to thank you for your time, as well as remind you that your items that you purchased are expenses, and they will depreciate over time. This doesn't mean that you can't buy these items. This just means that replacing them every once in a while is a good thing. And you must write all of these on your balance sheet as well as your income statement. Again, thank you for your time.